What if the safest investment in the world is not safe anymore? For decades, there was one golden rule. When the markets go bad, you buy one asset, and it was the bedrock of your retirement account and just like an anchor in a storm. But that anchor just dragged investors to the bottom, costing them billions of dollars. Today, we're exposing the hidden fragility in the assets everyone told you were safe, and what you need to know to protect your wealth. For generations, finance ran on one simple rule. When the stocks get scary, you buy the government bonds, specifically the long-term US Treasury bonds. These are the ones that mature in 10, 20, and 30 years. Think of this as an IOU from the US government backed by the full power of tax and printing money. Because of that, it was considered as a single safest asset on the planet. This was the foundation of the classic 60-40 portfolio, 60% stocks, 40% in bonds for safety. That logic was beautiful when the stocks were down and the bonds were up. That was the buffer that you got, the cushion that you got. Pension funds, insurance companies, retirees, they all built their financial lives around the bonds. And for a very long time, it actually did work until it stopped working. The first tremor hit on March 2020. Now, as the pandemic sent a world into a tailspin, investors did exactly what they were told to do. They fled to safety. But then the unthinkable happened. For 2 weeks, in the middle of the global panic, the price of the US Treasury bond crashed. The ultimate safe haven became a source of instability. It was called as a dash for cash, if you remember that term, a moment where even the most secure assets were dumped for cold, hard cash dollars. But that was just a preview. The main earthquake stuck in 2022. As the inflation increased, the Federal Reserve launched one of the most aggressive rate hiking cycles in the history. And that's where the quiet fragility of the long-term duration bonds was brutally exposed. Think of this as a seesaw. On one end, you have the high interest rate. On the other, you have the price of existing bonds. When the new interest rate goes up, what's going to happen to the price of the lower paying bonds? It has to come down. And the longer the bond's life cycle, the more volatility that seesaw moves. A tiny nudge in interest rate can send the price of a 30-year bond into a free fall. And that's exactly what happened. The long-term US Treasury bonds just suffered the worst drawdown in the modern history. The funds tracking 20% Treasury yields fell from 40% from their peak in 2022. So the 2022-23 period triggered the worst collapse for the long duration bonds in the modern history. The 40% of the 60-40 portfolio that was meant to be the protector became the anchor that actually dragged everything down. The stocks and the bonds fell together. That bedrock is now crumbled. So why did the risk that was always there in theory suddenly became so destructive? Well, first, the sheer amount of it. The US is running on massive deficit, as we all know, meaning it has to issue a never-ending flood of new bonds to pay its bills for the deficit. At the same time, some of the biggest buyers are stepping back. Now, the total foreign demand has been surprisingly strong, hitting a record of 9.49 trillion in early 2026, but that's not the whole story. The official buyers, like different countries' central bank, actually holding less than what they did a few years ago. So without the new demand of new buyers stepping in, the US would have to offer a much higher interest rate to attract that money. Second, the market itself is more fragile. Now, we have seen weaker demand in the recent Treasury auctions with lower the bid to cover ratios, which basically is a measure of buyer enthusiasm. So while there's not really a sell America panic, the underlying risk have created what some call as a sobering fragility. Third is the Federal Reserve itself. Now, Federal Reserve used to be the buyer of the last resort through quantitative easing. Now it's doing the exact opposite. The Fed is actually shrinking its balancing sheet by quantitative tightening and adding even more supply to a market that is already struggling to absorb it. This means the risk is not going away anywhere. Now, analysts now see the long-term upward pressure on the yields. So the days of the bond being automatic safe haven are over. Investors are now demanding a higher term premium. They want to be paid money for the risk of locking their money for 30 years, which makes sense. If you're starting to see how this massive shit could impact you and your money, do me a favor, hit the subscribe button. My goal is here to cut through all the noise and official narrative and expose the financial realities that no one else is talking about. Now, the weakness is not just the bond market problem. The same force that broke the long-term duration bond, rapidly rising interest rate that we talked about, is sending the shockwaves through safe parts of the system as well. Take the regional bank crisis for 2023, for example. Bank had also loaded up these safe government bonds when the rates were zero. So when the Fed hiked the rates, the value of these bonds catered, creating a massive unrealized losses in the books of these banks. A case in point, Silicon Valley Bank, the losses combined with the rush of withdrawals triggered a classic bank run. So the depositors, they pulled $42 billion in a single day because they suddenly realized that the bank assets were worth far less than that have been advertised by the bank. It was a brutal lesson. The safety of your bank is directly threatened by the very same risk that had crushed the investors. And lastly, there's the quietest risk of all, cash. In principle, it is protected in your savings account, but that safety is an illusion when the inflation is high. So from 2021 to 2023, the US inflation peaked about 9%, while the saving accounts were paying like 0 to 2%. That gap means losses of 5 to 8% per year. And if you compound that for 10 years, that's more than 50%. So over time, in 10 years, your wealth gets eroded. And they're not separate events, but the symptoms of the same disease, a financial system that is struggling to adapt into the new era. So the question is now, how do you protect yourself in a world where the safest assets are no longer safe and they're fragile? First, rethink duration. The biggest lesson from the crash is not that all bonds are created equal. The devastating losses were in the long duration bonds. The short duration bonds, the T-bills, the lifespan with a year or less are far less sensitive on these rate swings. They were a genuine safe haven during this chaos. So sticking to the short end of the market is a powerful way to reduce the hidden risk. Second, understand the new 60-40 portfolio. The classic 60-40 portfolio no longer works the way it used to be. Actually, I've developed a new way to look at this portfolio and a breakdown in the video that's showing up on the screen. Third, and the most important, stress test your investments. Stop taking safety for granted. For every single asset that you own, ask one question. What happens if the interest rate increases by 1%? If you don't know the answer, you have a major blind spot. So understanding your interest rate sensitivity is no longer optional. In fact, it is an essential for your survival in this market. For 2026, the analysts expect solid returns from the bonds, but mostly from the interest payment, not from the rising prices. This just reinforces the need for quality and intermediate term strategy. So the financial world has changed. The simple truth is the investments that we all saw as the ultimate truth of safety, the long-term duration bonds, is quietly fragile. So by understanding the duration, stress testing your assumption, and looking the safety in the right places, you can go from being a potential victim of the next market shock to a more resilient, informed, and successful investor.